Hello and welcome to a brand new show of Market Makers, our New Year special. 2015 has been a tough and a rough year for financial markets. It started with chaos in commodities, then the China problem accelerated the fall, and then we saw a virtual bloodbath in emerging market currencies. So what is in store for 2016, and how should one really view emerging markets as an asset class? Because emerging markets, frankly, in last 12 months, they have seen a mini rout. So to understand that, I have with me a very, very special guest, someone who's clearly one of the biggest foreign institutional investor in India, and to get Adrian Lim of Aberdeen Asset Management. Adrian, fantastic to have you back, and thank you for joining us. Adrian, 2015 has been a very, very tough and a rough year for emerging markets as an asset class. So do you think the pain is here to stay?
Well, I think it's very difficult to say, because even in the emerging markets, although the broad emerging markets class was under a lot of stress, there were pockets of growth, there were pockets of stock picks that could insulate you from some of these headwinds. So it's very difficult to say. We know that on the macroeconomic front, with the start of the rise in US dollars interest rates, that there would be some upward pressure in the cost of capital. But you can see that not all emerging markets have a similar policy in reaction to that as well. There are many markets that will continue to have a relatively loose monetary or capital policy, and to make sure that they are relatively insulated against the US dollar hike. So I think the policy response across the emerging markets can be quite different and can alleviate some of this pain. But I'm personally glad that the Fed has made the hikes and have started on this path, because we have been speculating over the last 18 months or so whether they will start and how soon they will start and what pace that hike would take. So I'm glad that that's out of the way.
So when do you think emerging markets will stabilize? Because according to our numbers, broadly emerging markets have seen a net outflow of $80 billion, and that's a huge number for emerging markets in general.
Yeah, I think the capital flow is something that's difficult to predict. Most observers have noted over the last 2-3 years that whenever the prospects of a North American or US recovery are clearer, or the chance of a Fed rate hike is higher, money flows back into the North American markets. So to some extent, the quality of the cash flow or capital flow across regions is dependent not so much on emerging markets per se, but also dependent on the relative attractions in the North American market. And that's very difficult to call. What we do know is that across the emerging markets, you can find areas which are relatively protected, relatively well capitalized, and you can look for companies that have got strong, resilient business models that would weather these difficulties. But in terms of the market movements, that's very difficult to call. Things look better going forward in 2016, but the question of whether we have bottomed out or not is something that we can't say yet.
Adrian, on paper, India perhaps is the strongest and the best emerging market. Even though India is the best boy in a bad neighborhood, the neighborhood is still very bad. So do you think India will continue to suffer as long as the emerging market neighborhood does not improve?
Well, I think that's also due in part to how India looks relative to the emerging markets neighborhood, as you describe it. India's made good progress on the fiscal policy, it's made good progress on its inflation numbers, pushing down inflation rates as measured by CPI steadily over the last 2 years. And its reserves are in reasonably good health. There are pockets of difficulty even in the Indian market. But as you say, the global asset allocators or capital allocators will still find it difficult to really move much capital into India if the emerging markets asset class as a whole remains under a cloud of uncertainty. What we do know is that these are probably the best times to look for bargains, to look for positions that you like to get into, and then ride out that storm. So this is actually a good time if you have a 5-year time frame for investment to pick selectively at the equity markets. But it's a very difficult time to call if you've got a much shorter time frame than that, as most people would look at 3 months, 3 weeks, three quarters, that's a more difficult decision to make.
Well, the hallmark of your mutual fund, Adrian, has been that you always buy stocks for long haul, and names like HDFC or an ICICI Bank, they've been part of your real classic long-term portfolio. So what's been your India strategy of late? At a time when the global environment has been very stormy, have you increased your exposure to India? Because like you said, that India is relatively the better or the best story.
Yeah, I think our Indian position over this last year have been pared down a little bit. It remains an overweight. Whether you look at the Asia Pacific benchmark, or you look at the Asia including Japan benchmark, or the global emerging markets benchmark, whichever of these three benchmarks you use, you would see that our position in India is an overweight one. That's not so much driven by the macroeconomic attractions of the Indian market, but by stock-specific qualities. We find it much easier to identify and to get really comfortable with the quality of Indian corporates. Like you mentioned, HDFC, ICICI Bank, HDFC Bank, Kotak Mahindra, these are strong positions, big positions within our funds. I think the difficult thing for us is to predict the pace and the inflection point of recovery. The strategy has been the same, the approach has been the same. We look for quality companies, we look for companies that are well run, well managed with a good balance sheet, and that will not change. And India, with respect to the rest of the emerging markets, as well as the Asia Pacific region, has a disproportionately high number of these good quality companies.
You mentioned that you've reduced your India exposure. Is that largely because of compulsive redemption pressures? Because if you have redemption, you have no other option but to sell what you own. Or have you reduced your India exposure largely because of rich valuations?
Oh, I'm specifically referring to the valuation levels. We have reduced the percentage exposure in India. And this would be as a proportion of the assets under management. So even if you adjust for asset under management fluctuations, the position in India would have been incrementally reduced. It's not a large reduction, but it is a reduction from what it was in the past. And this is very much due to valuations that we've had or we have enjoyed in the Indian corporate space over the last year and a half or so.
Right. So what is your take on valuations right now? Have valuations become attractive? Are they in your comfort zone, or you will only revisit your good old favorite stocks on a 10 to 15% correction?
Well, a 10 to 15% correction would be helpful when you're looking to buy things. But India is not a cheap market, so quality for us is a bigger driver of our decisions than the valuations per se. India, over the last 15 years or so, in the stocks that we like to buy, have hardly ever been what you would call bargain basement cheap. It's always been fairly valued. But what commands a premium is that we are comfortable with the business models that some of these companies have, and the resilience and the quality of the management teams that you have. So that's been the attraction to us, not so much the outright valuations.
What is your view on Indian economic recovery? Frankly, Adrian, when we started the year 2015, there was a lot of hope and a lot of hype. Now a bit of a reality check has kicked in, which is that Indian economy will heal, but the pace of economic recovery will be a long-drawn one.
Well, to forecast the pace of that recovery, we need to look at quite a few things. Number one is that the rural economy has started this year. The monsoons have been weak, but more importantly, the prices of soft commodities globally and in the region has been soft. So the amount of liquidity and spending power that goes into the rural parts of India has actually been a lot softer than it was in the past. So that's one aspect of it. The other aspect of it is that in quite a few sectors, India has quite a lot of capacity. In cement, for example, utilization rates are running at about 70-75%. And that means that for quite a few of these companies, they would be waiting for a greater level of utilization before they would pick up on their capital expenditure, and that would drive consumption or demand going forward. So we have to wait for a period where the rural economy does pick up a little bit better, but as well as the utilization rates for some of these sectors to improve as well. The export sector is also quite important, but it's not such a large driver of demand in India. Only about a third of the economy or third of the listed entities actually export overseas. The software and the pharmaceutical companies are important, but in relation to the rest of the economy, it's domestic demand that's a key driver to the Indian economy.
Adrian, last time when I interacted with you, you said that if given an option to only buy and never sell, that stock will be HDFC Limited. You said you love the management, you love their disclosures, and you're confident about the growth of the Indian housing market. Now, HDFC Limited has corrected quite a bit, and certainly more than 15%. Like you said, 15% is a good correction. So is HDFC Limited now an attractive stock to buy?
Yeah, I think it depends on your time frame, but if you have a long view, HDFC is something that you should always have in your portfolio if you have a 5-10 year view. Housing penetration levels are low, home ownership levels are still low, and HDFC focuses on the mass market or the man on the street, not on premium or luxury accommodation. Most of the portfolio that it funds or finances is to do with owner-occupied property. So what it does is that it has a very basic service that's important to the country, but it does that very efficiently, and it does that at a very affordable price. It's very productive and efficient, and we think that its relevance to the Indian economy will be suitable for a long time. Now, when you put the question through as to never sell, I don't think you can ever have a stock that you never sell. That doesn't exist. But something to always consider on your buy list, HDFC would be one of the things we would look at.
Adrian, not only in India but globally also, you don't invest in PSU or public owned companies. Now the story in India is different because large part of the spending actually is not coming from the private sector, it is coming from the government, be it railways or defense or for that matter roads. So are you not tempted to look at PSU stocks which historically you've avoided in the past?
We've had PSU stocks in the past before in India, and we have got state-owned or government-owned companies peppered across our regional portfolios as well. But you are right, it's not something we gravitate to or get very comfortable with. In India, you do have a lot of choice when it comes down to state-owned companies. You've got the commodity space, you've got freight, you've got the railways, you've got a lot of infrastructure, you've got a lot of financial services. There is a lot of choice. But we must make sure that these companies are efficiently run, are well run. And when we do our homework on the Indian listed universe, we find more efficiencies, we find more profitability, and we find more focused companies in the private sector. It doesn't mean that the public sector is bad, it's just that the private sector is relatively more attractive. So we will continue to look. There are some names that are interesting, but so far most of our exposure, especially in India, has been in the private sector companies.
So in this current turmoil, have you changed your portfolio positioning in a meaningful manner, or you are sticking to same old favorites?
Well, there has been a lot of volatility in the market, and certain sectors are under pressure. We have made some minor adjustments, but if you look at our top two sectoral weights, if you go by sector, it would still be in finance companies or the financial space, and it would be in the software engineering space. So those two still form about 45% of the Indian fund at this point in time.
Now, you always focus on a very basic metrics, which is return ratios and cash flows. Whereas Indian IT companies are still generating tons of free cash flow. That cash flow is ensuring that the return ratios are coming under pressure, and Indian IT companies are no longer growing at 30%, they are growing in late teens or early teens. So do you think best of the return period for IT sector is behind us?
It depends on what you measure by returns. If you're measuring returns by returns on equity, the equity invested in many of these IT companies is not large. If you're talking about the growth pace, yes, the growth pace of these Indian software companies have come down, but so too have the valuation levels. In the past, software companies in India were trading at 30, 40 times PE, forward-looking PE. Now you can buy TCS or Infosys in the high teens PE. So for us, it's okay to, you don't have to have the greatest growth rates. There is a trade-off to valuations, and you need to look at both the pace and the quality of that growth rate with the valuations that are required to buy into those companies as well. And we think that balance is fairly attractive at this point in time.
As a shareholder of Infosys, or as one of the largest institutional shareholder of Infosys, are you excited about what Mr. Sikka is trying to do? Because he's trying to not only reboot Infosys, he's trying to change the complexion of the business. Historically, Indian IT companies have been IT services companies. Now he's trying to add a new dimension, which is product and platform.
Yeah, I think what Mr. Sikka is trying to do is challenging. It's interesting. But there are two things here. You do need to improve the effectiveness of their services platform. There were some challenges there. There were some things that they needed to fix, and that's being done. And then they have to move on to this next stage of products as well. And these two things are what will drive the growth going forward. So it's not just the new thing, but they do have to go back and improve the way they did the business that they had been doing very well for until the last 3-4 years.
You mentioned that rural economy is under pressure, and there are two factors: poor monsoon and commodity prices or soft commodity prices have come down by about 15 to 20%. If that is the backdrop, can a two-wheeler company do well? Do you think Hero Honda now is going to suffer given what has happened to the two-wheeler market?
Yeah, I think you will see headwinds in the rural economy, and we will feed into many different sectors. It goes into fertilizers, it goes into seeds. That's the most obvious, but it also goes into capital equipment, things like tractors, things like Hero's motorbikes. And Hero has done a phenomenal job penetrating and having good traction in the rural economy. So that is one of the things that will challenge it. But the rural economy will not stay down for a long time. And I think having an exposure in Hero gives us very good participation when the rural economy does turn. We do find that the strength of the brand, the strength of the distribution, and the strength of the product are pretty much unchallenged in the rural space, and it would take quite some time for competitors to replicate that level of resilience in the rural market. So yes, it's challenged in the short term, but we think that this is also a good time to be getting some exposure into rural sensitive economic activities at a decent price.
Like they say, you should always buy a raincoat in winter, not at the peak of monsoon. What are your thoughts on the Indian pharma sector? Because Indian pharma sector historically has enjoyed a huge advantage, both in terms of skill and in terms of size. US FDA has become very stringent, and that is one sector which has seen the maximum downgrades. Is it time to shop, or is it time to avoid?
I think that's a very challenged sector at this point in time. The regulators have been increasingly interested and paying attention to a lot of Indian farmers, and part of that has to do with the fact that Indian farmers have become so important to the generic space in the US and in many of the European countries as well. The best ones will learn to deal with the regulators and will learn to adjust. They basically provide strong a strong product at a competitive price to their consumers. So I think that the long-term sustainability of this business model remains intact, but there will be some short-term headwinds, and I think it's really crucial here to pick the stocks that you like. I hesitate to talk too much about which stocks you should buy in the pharma space because there are so many different opinions and there's very little consensus in the Indian pharma space. But I can tell you what we hold. We like the quality of the management teams there. We like the balance sheets and the product portfolios that they have there. So I can tell you that we have quite a bit of Glaxo, quite a bit of Sanofi, and then we have a bit of Cipla, and we have a bit of Sun.
Adrian, I'd like to draw your attention to the real quality end of the market, something which as a fund house you focus on. When I say quality, consumer staples, MNC pharma companies, do you think quality stocks or the absolute blue chip stocks in India priced to perfection and one is giving some of these companies more like a miss or more like an avoid? Because you focus on quality, but quality also has to come at a good price, and unfortunately quality stocks in India are not trading at great P multiples.
Yeah, I think quality stocks everywhere, not just in India, will trade at a premium. And if you define quality as a good product, a good brand or service, and strong, resilient business models, I think those things will always be valued. They can come out of favor, as that happens sometimes, as people are looking for the technical play or the liquidity play. And when times are good and there's a lot of confidence in the market, people sometimes think that quality stocks are too boring. We have a long-term fascination with quality stocks, though, and we think that it's far better to invest our clients' money in these stocks that are fundamentally sound, rather than chase the next new thing on a short-term basis. But you are right. Some bits of quality stocks in the region are out of favor, and but we are comfortable with what we're reading from the quarterly numbers and from our interactions with management. So it's not an approach that we will change anytime soon.
Let me get some closing comments from you. As an outsider, how would you view the reform process in India? Because the believers would say that the current administration is doing all the right things. The critics would say that nothing has moved, and a bill like GST also has not gone through on the floor of the parliament. As India's biggest institutional investor, how would you view the government reform?
I think the government has done quite a few things quite decisively. Since the BJP government came on board, it moved things like the limit on foreign ownership in quite a few sectors quite quickly. It dismantled the subsidies for fuel quite decisively as well. And then you have things like GST, you have things like the lower corporate tax rate. And those things need a wider base of consensus than the other things that we mentioned. I think having been invested in India since the 80s, we have come to know India as a relatively, as a big, very vocal democracy, but one that sometimes for some of these more ambitious policy plans that will take some time to get through. I'm still pretty positive that this government will be able to make decent progress on those two issues. So I stand, or I sit somewhere in between the most vocal critics and the most vocal cheerleaders. I think they've done well to date on certain things, but I think some of the issues that are challenges, the government needs to work quite closely with the other people in the various houses, and that's something that brings a different level of skills from what they have been able to do in the past. So I look optimistic. I am optimistic, and I'm looking forward to those other reforms getting passed.
Adrian, fantastic to have you back on ET Now. Thank you for your time, and thank you for this opportunity for getting your thoughts out to millions of viewers. Wish you and your family a wonderful 2016 ahead.
Same to you. Bye-bye.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.